Hello and welcome back. My name is Josh, and today I want to investigate a stock IVR, also known as Investco Mortgage Capital. This was recommended by a subscriber, Tanner. So if you'd ever like me to look at a stock and you have some suggestions you want me to check out or analyze, just subscribe and mention it in the comment section below. I will respond to you and happy to look at some stocks as I'm always looking to learn more about investments and the way I see it is we're on an investment journey together, and hopefully I can learn some stuff and find some great stocks and help you also learn some more about investing. Um, so I don't have any background in this stock until recently. I did the research just before this, but so what is Investco Mortgage Capital? Well, Investco Mortgage Capital is a REIT. A REIT again is a real estate investment trust. So they typically a REIT invests in properties and makes revenue based on the income they bring in from the properties by renting it out. However, there's a different kind of REIT called a mortgage REIT. A mortgage REIT doesn't actually own properties, instead they own the mortgages that support those properties. So that's what Investco, I'm just going to call it IVR. So that's what IVR does. They own mortgages and they make money based on the spread of those mortgages. So if we look at the history of IVR, we can see it fell off a cliff. It's down still 80%. Many stocks dropped during COVID, but this one especially so. And so Tanner is wondering why that is. What is he missing? You can see here it's got a very high dividend yield. Is that dividend yield potentially at risk? Or is this due to bounce back? Because obviously, if it gets back to where it was, there's huge upside here. In fact, I actually was investing in a similar company a bit ago, NRZ, I believe, NRZ stock, new residential. They also deal with mortgages. They've actually done, you can see they dropped off a cliff too, 16, all the way down, also about 80%. They've slowly climbed back up. I think I sold around $10. So there's a little more juice to squeeze, but I said, you know what, I'm good. And also has a very high dividend yield. I will note, like the average dividend yield, for those who don't know what a dividend yield is, it is the ratio of dividend payout to price. So if it's 10% like IVR, that means they're paying about 10% of this per year. So 30 cents for one stock, you'd pay about 33 cents in dividends. The average is about 1 to 2%. And some companies pay zero dividend because they want to reinvest that capital. That would be fast growth companies like Tesla. More mature companies are typically dividend paying companies. You don't want a dividend that's too high. In fact, it typically means the price has dropped a lot, which can be concerning. Maybe why would that be? Or it could mean that the dividend's at risk. And if historically you've paid out 3 or 4% dividend, and suddenly it's up to 6 or 7, maybe that's because their revenue's dropping, and so they say, you know what, we gotta cut our dividend and have it down to 3. And typically, when there's a dividend cut, you'll see the stock drop even further, which can be kind of a death spiral because they cut the price of the dividend payout, which drops the stock price, which again makes the dividend yield higher again. So high dividends are not necessarily good. You have to look at how stable is this dividend, how likely are they to pay it off. But if it's a stable dividend, I mean, it can be good to have a high dividend. Okay, back to IVR. So again, they're a mortgage REIT. That means they own mortgages, and they actually own very specific kinds of mortgages. You can see here that here's a bit about mortgage REITs. They own, I believe, mortgage-backed securities. So what does that mean? That's actually the same thing that happened in the MBS. There you go. Mortgage-backed securities. Mortgage-backed securities is the same thing that tanked the economy in the financial crisis, and you might have seen them in The Big Short. That doesn't necessarily mean they're bad, but what they are is a mortgage-backed security is an investment. So they basically take a bond, which is a security, and that bond is made up of a lot of individual mortgages. So in this case, they might take 1,000 homes, and each of those homeowners are paying the bank 3% or whatever interest rate. And instead of the bank holding that on their balance sheet, they'll group those together and sell it as a bond to a pension fund or something. And the pension fund then says, great, now we have a bond that pays 3%, that the income is based on the interest payment of people paying their homes. And again, this is typically safe because, again, the whole logic is who doesn't pay their home mortgage? Obviously, it backfired in the financial crisis, but typically these are actually, I think that was an extreme event, and there were other factors at play. It wasn't necessarily the mortgage-backed security that was the issue. It was the fact that too many mortgages were being given out too easily to too many people that were variable rates. So, after a year or two, the interest rate would jack up, and then people couldn't afford to pay uh, this mortgage back. So that's a bit, again, more about the financial crisis. But I do think it sets the context for what is a mortgage-backed security. Specifically, IVR does government-sponsored um, mortgage-backed securities. So they're only doing ones that are basically protected by the government. Now, this is important because these are very safe assets. Typically, they're backed by the government, which means that if they aren't paid back, the government's still going to pay them back their mortgage, which means typically they have a very little spread. And there's two kinds of investments. Typically, people say there's risk on and risk off. Risk on are when the economy is good, they do really well. You can see that as tech stocks like Tesla. When the economy is good, Tesla does really good, really well. And there's other stocks that don't do as well. Then there's risk off stocks. That's like if the government said, "Hey, we're raising interest rates," Tesla would be hit a lot harder than Procter and Gamble, for example. So there's certain stocks that are risk on, which go up faster, and certain stocks that are risk off, which are when people are nervous, they go risk off. This is a risk off stock. This is, again, it's very safe because it's backed by the government, and it's not going to have huge returns. You can see in its history, it basically was trading flat. It is actually down. Now, again, just because the stock price is down over a period of time doesn't necessarily mean the total return was down, because if you're paying out 5 or 10% a year, you can still have the value go up to you. Because if you're making, if it was $20 and you're making, let's say the payout ratio was 5%, that'd be $1 a year. If you're making $1 a year, yeah, the stock price is lower, but your overall return is, hey, I've also held it for 10 years, which means I've made $10. So my overall holding is, maybe it's only worth 15 plus 10, 26. So you could say it's up 30%. That's the way of looking at it through total return, which is a good way of looking at it. You do want to factor in dividends. Typically, the stocks I invest in have lower dividends or no dividends, so it's easy and you can just look at stock price. But when you're dealing with stocks that have a dividend payout, especially high one, you really want to factor that in. So, one, this is a risk-off stock. It's a less risky stock. It's very stable, not very volatile. And so right now we're in a hot market. If you look at the S&P 500 chart, we have been on an absolute tear. In the last year even, the economy, they say, goes up an average of 7% a year. We're up 31% in the last year. So we've been on an absolute tear. So because of that, people are going into riskier and riskier things, especially with low interest rates. They want to chase yield. That means that people aren't as interested in IVR because there's just not a market for super safe assets right now that don't have a high payout. So that's one. Let's dig a little deeper and go into the actual financials. So this is really unlike a REIT that owns property, which is more like an actual business. Again, you're getting cash flows. A mortgage REIT operates more like a bank, and banks have unique characteristics that mean you have to judge them a little differently. As you see, IVR is trading at a 4.5 PE. That seems extremely low, but financial companies typically trade at weird PEs because of the way their earnings work. So a better way to analyze financial companies, whether that's banks, insurance companies, or in this case, a mortgage REIT, is price to book value. Now, what's book value? Book value is the difference between it's the difference between your assets and your liabilities. You could also call it owner's equity. I believe that's it. Equals the cost of carrying an asset on a company's balance sheet, and the firm calculates it. Book value can be thought of as net asset value. How many assets under management? Sorry, that's what it is. What did I say? I guess I said it incorrectly. No, here, the book value is the net difference between the company's total assets and total liabilities. Yes. So That's the way to look at it. So let's look at, we can look at it from a PE ratio. Again, PE ratios aren't perfect, but it can often be good to understand where a company's trading now versus where it previously was. So, if a company used to trade at 20p and now it's trading at a 40p, you might say, why? Why is it trading at twice the ratio? So for IVR, we can see it typically was traded at actually about between 1 to 2 PE. Obviously, there were spikes here, but over the long run, it's traded at an extremely low PE. Again, this is unique to financial companies. And we're actually now, again, what do we say? It was at a 4 PE recently. So this is trading it's trading above its normal. Again, if it's typically trading at 1 and now it's trading at 4, you're talking at a 4x increase. And this is about an 80% drawdown, which means you're going down 4 times, right? Like if it was 20, approximately an 80% decrease is 1 over 5. So it actually this is close to 5. So you could actually say, hey, you know what? This seems to be maybe overvalued because it typically should be even at this lower rate. Okay, so that's 1. 2, price to book value. Well, we see here, this is book value per share. And you can see here that book value per share dropped off a cliff. It dropped about 50%, and now it's actually it was about 20, and now it's down to $5 last quarter. So that's, again, a 75% drop, which very closely mirrors, again, the 80% drop in the stock price. So, again, they have less book value, which is why, again, the price to book value is typically around 0.25, and now you're looking at one that's much higher. So, again, it's trading much higher than it historically has. And when you actually look at their revenue, you can see the revenue has also fallen off a cliff. So it does seem to be trading. The reason for the drop seems to be explained by, well, they have less revenue, less book value, and that correlates to the drop in stock price. So that's a major reason why. Could it bounce back? Of course it could. However, again, because this is a mortgage REIT, again, whenever I'm analyzing a company, I try to analyze it based on my 3 things. So 1, what's the macro environment? So again, we talked about it. It's a risk-off asset, and we're in a risk-on environment. People are chasing yield. So right now, this is not the right kind of investment for this environment. That means if we did start going risk-off, if inflation fears continue and rates start going up and people start freaking out, we could, and maybe even COVID gets worse, we could definitely see people start buying these kinds of stocks. So it could be a good hedge against that. But that's the macro environment. Also, rates are extremely low now, but they're going up. So that's 1. Financials, we're looking at the financials now. But the third thing is understanding the product and value. I automatically ding this as an investment because, again, I like to understand the product. I understand Spotify. I use the product. I like it. I'm a big fan. I have a mortgage, so I understand mortgages to some extent, but I think that oftentimes when people look at investment, they miss the complexities there's some investments that are very tough to analyze and understand unless you're in that industry. And this is one of them. There's complex financial ones, whether it's insurance companies or stuff like that, that unless you're understanding the ins and outs of that industry, you may not understand why revenue's down or book price is down. I'm not an expert in this field, so I ding it immediately because I don't understand it. So, I wouldn't invest in this only because at this time I don't really understand at a core level why this revenue's gone down. My understanding is because they make money on spreads, and in other words, when mortgage rates are higher, there's more likelihood to be a higher spread. When interest rates are lower, you have a lower spread, and you're making less money on a mortgage. So this is one of the reasons why I believe it is lower interest rates are bad for this business. So rising interest rates could be good for it, for sure. So again, this could be, again, seen as an inflation hedge, but I'm not an expert. And so to me, you always have to say, what don't I know? That's thousands of stocks out there. I think there's literally 5,000 stocks. So could this be a good investment? It could be. It could be an inflation hedge. It could be, if you wanted to look at risk off. But the way I see it is there's complexity, which means it's hard to analyze. Um, it's it's not in the right environment, and they have seen a dramatic drop in their revenue, their book value, and it's trading above where it typically has in terms of price earnings. Even if they doubled or tripled, even if they quadrupled their book value, uh, you know, what was it? Sorry, their book value used to be zero point 0.3 or 0.25, zero point 0.3. Let's call it 0.25, and now it's about 0.75. So it's trading 3 times higher than it typically has. That means, in my mind, even if their book value per share tripled, the stock price shouldn't actually go up because they'd be in line with where their previous value is, right? Think about it. If this triples, you go from 5 to 15, which is still less than it used to be, but close. But your book price per book value would still be 0.25, so you'd be in line. So the best investments are where both you see growth in revenue and multiple expansion. Multiple is, again, what's the multiple you're paying for that? I see here that even if you got uh, revenue growth, it would be counteracted by multiple detraction. You get a compression of that multiple. So I personally would stay away from this. Not saying it's not, could be a good investment. Again, there's thousands of investments out there, and some of them I'm going to avoid, not because they're not going to be good. This could be good. I avoid it because it's too difficult. There's too many risks, too many uncertainties for me to truly understand. I want to put my chips on where I think I have an edge, and I don't think I have an edge with IVR. And I understand why it's dropped so much. Its book value's down, its revenue's down, and it's just not in the right environment for this kind of thing, and mortgage-backed securities. So that's my analysis of Invesco Mortgage Capital. Hopefully this was valuable. Shout out again to Tanner. Thank you so much for recommending this. If you have any other recommendations, anyone who's watching, please let me know in the comment section below. I'd love to learn more about different companies that people are looking at. And again, I see this as a journey of me learning more about companies and analyzing them. I didn't really understand mortgage REITs, and this really helped me understand them more deeply. So thanks so much for watching, and talk to you next time. Cheers.